Good morning, everyone. Welcome to Bank Holiday Monday here in the UK and across Europe. If you're here for the very first time, you've sort of randomly stumbled onto this stream. My name is Deeyana Angelo, better known as Market Stalker D. I've been trading for 18 years, 13 years out of which I've been trading futures. And I am a Series 3 qualified trader. However, everything we say here is for educational purposes only because I'm not a CTA. Now, like I said already, we do have a bank holiday across Europe and UK, which is probably going to mean that any sort of big moves and stuff are probably not going to be happening unless we get some headline risk or Mr. President wakes up and starts chirping. So we still need to be a little bit mindful of that. But in absence of any headline news, headline risk, I would expect that this is probably going to be pretty muted. Looking at the volume on the weekly chart, it's starting off pretty meh on copper. And that kind of reinforces the idea that until we get COMEX open, it's probably going to be pretty quiet. I was thinking maybe we could make this into more of a Q&A session, like an educational side of things, letting me know what you guys are struggling with. And maybe we can go over some levels that I like to use and what each of those lines that you see on my charts mean. With that said, I'm just looking at copper now on the intraday time frame, and as expected, they tried to go above the initial balance, and then that was promptly stopped in its tracks. At the moment, we're staring at the initial balance size of 61. That's kind of on the low side for the types of ranges and volatility we have on copper at the moment. So yeah, we're gonna wait. Asia did a little bit of an uptrend, but even that was kind of done all in one go on a 30-minute chart, and then it's kind of crawling. But if you look at the last nearly 3 hours, 2.5 hours, it's very, very range bound, right? So just a little bit of caution if you plan on going gung-ho into this lovely Monday. And we will also have another bank holiday in May, 5th of May. So that's also probably going to be very, very similar. All right, so let's just have a look at some of these large time frames and see what we have going on. Now, on the large time frame on copper, I can see a very, very big drop. They tried to go lower. That was promptly retraced, and now we're kind of tracking back into this one big area. You can look at this weekly chart in a similar way that you would look at single prints intraday. So what does that mean? Well, single prints can act as areas where we expect fairly fast price action given the time frame, but it can mean either a pullback, but when we start tracking through that area, you can actually expect a full retrace, exactly right back where it came from. Whether that happens today, tomorrow, or towards the end of the week remains to be seen, but that's the expectation. There is no real initiation to the downside at the moment. Every time it looks like copper is going to go lower, the buyers step in with quite some force and they just push it up. There is another thing that can happen during low volume days, and that's like basically these zombie rallies, the price that just kind of keeps trickling upside and keeps going without too many pullbacks. That is definitely a possibility. But at the moment, I would expect that most of the people trading today are just retail traders, right? Thoughts on oil? Well, similar outlook. Let's have a look at oil. Just going to pull it up. Now, oil just rolled into a new contract. It is attempting to accept the Friday's value, but again, be very, very careful because the initial balance size was only 20 ticks. That could either mean a super large trending day, or it can mean a complete nothingness, just like one big storm in a teacup. I don't have many thoughts on oil. Oil over the years has had, it's had a downward bias. Now, I don't know whether we can do a monthly chart. Oh, we can. Okay. Let's have a look at where we are on very, very large time frames. Have a look at the bird's eye view. I mean, what do we see here? Let's imagine that this is like a 5-minute chart or something. What do we see? We see a range, right? So until this whole structure is firmly broken, I would say that until we go below 60 on this contract, I would still consider crude oil to be in range. We had a couple of outlier days driven by headline risk. They did sort of pop the crude oil back into its old self of running about 400 ticks in the same direction. I still don't think that's the norm for crude oil. We've spent way too long in $1 ranges, and I'm not really seeing too much change there apart from an odd day here and there where they kind of go in the same direction, and then pretty much that's all you get. Crude oil is very whippy. I have shirts that were like merch that we used to wear quite a bit saying crude oil is slippery. I do think that it still maintains that personality. So even if you think, oh, I've got a really good one, there are certain times of the day when crude oil just completely goes nuts. And there's a reason for it. There's this thing called the Forex option expiries every day at 10 a.m. Eastern. That's 3 p.m. over here in London. And that's when the Forex linked products tend to react the most. Copper is one of them, gold is another, and yes, crude oil is another one. It has a big connection with the Canadian dollar. So if you are looking at doing something, initial balance trading in crude oil is generally very directionless on like 92% of the days. So, you know, doing things like opening range trades that, by the way, work swimmingly well in equities, it's not the best idea, in my opinion. I've been trading crude oil for 12 years. Last year, I sort of divorced it quite a bit because I thought that it's not the same market. I've spoken about this many times before. In fact, we have a running joke that crude oil is like a toxic ex-college girlfriend that keeps popping into your life, right? Giving you a little bit of hope, but then it all goes wrong. And when I say goes wrong, I mean it just gets stuck in a range, usually between 30 to 50 ticks, and just does nothing for the next 3-4 hours. And this is something that happens during NYMEX. NYMEX is supposed to be its like the biggest session. But save for those, few days when we do get some kind of a trend, and that seems to happen out of hours. It seems to happen during Asia, sometimes even during the overlap in London. I would be very careful with crude oil, but from this very large time frame, I mean, it is a range, so as long as we stay above 60, I probably wouldn't be shorting it. And with longs on crude oil, if I look at all of my trades that I've done for 12 years, a lot of the successful ones were shorts, and that tells you that crude oil generally has a short bias. Now let's have a look at the weekly chart. And again, there's a bit of a formation here called the morning star. So this pattern is characterized by a doji candle in the middle, and then a kind of a normal sized candle that is going in the opposite direction. It is a form of a 3-bar reversal. I actually like to delineate the 3-bar reversals in several structures, and each of those has their own probabilities. There was a structure called the 3 inside up, where the second candle is more like another bear candle, and even maybe a bull candle, but it's got big wicks, and then it has a very, very massive third candle that smashes through the high and the close of the first candle. If I'm in on that on any time frame, that would be my profit target. So I wouldn't chase more because that third candle is so big that usually it brings a very large pullback, if that makes sense. At one point, I do still have my candlestick workshop on some of my my websites that talks a lot about this. So let's not spend too long chatting about candlestick patterns and probabilities. On the daily chart, we're already seeing that slow day taking hold. There is a bit of a pullback here. Whether that has any juice behind it remains to be seen. It is trying to go lower. So, like I said, 60 is the cutoff point. So maybe if you want to do some shorts to that 60 level and then see how they behave, that's one idea. But there is one thing that I'm not really happy about. So on the daily chart, we have a reversal pattern for signaling longs. I'm seeing shorts intraday. I don't like it when the large time frames and the small time frames are not matching up. So that means, probably not a good setup, right? Let's carry on through the time frames. This is a 4-hour chart. Again, volume pretty low. So haphazardly going higher overnight. Haphazardly going down overnight. And now it's a decision point. So let's see what they want to do with this. 30-minute time frame. VWAP still a bit flat. So if the slope starts sloping, might be a little bit better. But just going through all of the time frames now, VWAP is still pretty flat. But it's sitting below the visible volume range POC, point of control. Contrary to its name, point of control is not a control of anything. It is the middle of the middle. And unless I'm on a super small time frame, I'm not really that keen to get involved anywhere near it. So again, another slight issue that I have here is the point of control and VWAP are both at the same level. So what tends to happen if we do manage to turn around with that outlook from the daily chart and the daily chart, I think it was a daily chart. If it goes up and then shows some strength, this is probably not going to hold. And, crude oil likes its VWAP just like any other product. It is the point where most volume was traded, so I'm not super surprised to see the point of control is there as well. I'm just not liking the flatness of it at the moment. Let's see what time and sales is doing on the main contract. Bit patchy. And look at the size. This is all just retail traders driving this. One. This is not looking that great. So let's wait. Let's be a little bit patient here. And so I would probably wait until like at least 11 o'clock my time. So another sort of hour and 15 to see what happens when Americans start waking up. Because right now I'm a little bit suspicious of everything that I see here. Pablo Rodriguez says, "Good morning, Dee. Do you give same relevance to the low volume nodes and the high volume nodes?" I give relevance, but they are not going to be the same. High volume nodes typically will mean that you get a speed bump. So it's going to be difficult, especially if it's a larger time frame. It's going to be difficult to break through the big volume nodes, right? And that's why when the price does break through it, it means you have quite a lot of volume kicking that in that opposite direction. So if we were looking at this high volume area at 63 as a potential area of interest, if they keep knocking against it, pushing a little bit deeper, doing a stop run, I would be very careful shorting immediately, because that means that they are trying to break through it, right? Once that gains steam, we have the low volume area at 63.40. That could be a reversal area. Why? Because thin volume means that the price is probably going to move through it pretty well. You can look at it as kind of like a cave. It is an intraday gap of sorts. So the first step would be to maybe run a setup up to that point and then see what happens. Because at the time of the low volume node, when it gets reached, we know price is going to move there quickly. Now, but you don't know the direction of it. You can have it go through it in the same direction, but you can also have it reverse on you. So, you need some sort of a different context from maybe another concept to see what would make the most sense. You can take a look at the trend. You can take a look at whether there's any options there of note. You can see whether it's a round number. Is there a larger time frame supply edge? Like, all of that can come into consideration when you're deciding whether a low volume node should reverse or whether we should carry on through it. But one thing that I have noticed is that upon the first test of those low volume areas, nearly always you have the reversal first, and then they kind of decide what they're going to do with it. But for now, let's go back to copper, because like I said, me and crude oil, I'm just not really... I'm not believing in the crude oil trend, primarily because of what we have on the large time frames. It's still a range, So I want to give them time to decide what they want to do with this whole story. I mean, technically ranges have increased, but for some reason we still have days where, just still moves like 105 ticks for the entire day. And you're like, what are you doing? So yeah, we need products that move consistently. If you have to change here's my issue with it. If you have to change your strategy daily because one day something is trending and the very next day it's completely range bound, and I'm talking like polar opposites. It's not like, it's a little bit of a trend that you can manage. No, it just goes screaming in the same direction, and then for the next week or so you still get stuck in 100 tick range or less, like 30 to 50 ticks, because usually those 50 ticks that it does on the first try, that's it, and then it gets stuck, right? To me, it's way too much adaptability, and it would cause me to have to reevaluate everything. So stop sizes, targets, complete change of strategy. Because on my range days, when I see a range, and if we still have a reasonable span of that range, I would expect to keep the stop loss sizes the same, but I might reduce my targets down to 1-to-1s at that point. But if we have a big trending day that's caused by headline risk, so now I need to expand the stop, and I have to expect a trending day, which is a bit of an outlier these days in crude oil. So to me, it's too much shifting of things every single day. So I am somebody who's a little bit OCD when it comes to my strategies, and I don't really like products that do that. One time they are, beautiful, trending, and then 5 days later, still in a range, and then one day trending during Asia. Nobody knows why. It's like, we used to have NYMEX as our main session. So just by the fact that it's not doing that on a consistent basis, like one day it moves through Asia, another day it moves through London, another day it moves during New York. Markets are generally not that random, or they're not supposed to be. So I'm thinking that all of the stuff that's going on with crude oil good days is driven by headline risk, and that still worries me, okay? So just wanted to clarify why me and crude oil are not the same. But yes, I do give relevance to high volume nodes, low volume nodes. My thoughts on NASDAQ. I have no thoughts on NASDAQ. It's not really my core product, nor do I like trading it. I think we have more than enough NASDAQ YouTube channels. It is heavily, heavily covered during the main broadcast. I am somebody who dislikes NASDAQ as well, but I like YM. So let's have a look at YM. That's as close as you're going to come until we get DAX of me getting involved with equities. So what do we have on the weekly chart? We have, actually let's have a look at the monthly, because kind of creeping into the end of the month here. Now, Dow to me has a similar look to what ES was doing. So we have this very well-defined top. Now, granted, ES was a little less crazy, but Dow is a slippier product. So if you look at this former well-defined top, we're above it, right? Now, if the market goes below 38,450 and manages to close the weekly chart there, I would consider that to be accepting that previous range and more shorts. I would expect more shorts, certainly towards this area of high volume here. We also have some demand levels that we can fall back on just for targets. So here's one demand. And that would be the nearest one, all the way down at 35,500. Now let's see what the daily chart is doing. Daily chart, one attempted move higher, all in one day. This was a monstrous move. I think this went for like 2,500 ticks or something. And if you're on my Twitter, you would have seen me post something very similar on ES, because before this move happened, right? Because I thought it was interesting that we're reaching that very well-defined top on the monthly, and I'm like, let's see what happens here. And sure, it took a couple of days to come true, because those large time frames, they sometimes take, I mean, sometimes they can take a couple of weeks to actually materialize the setup. But yeah, all in one day. And then since then, nothing, right? Anytime I see a demand area that was created just by like one big pump and then nothing, I actually consider them low quality zones. So do I expect a reaction from 38,452? Maybe a pivotal reaction, but I would actually be looking for this to break, purely because we have not had a follow through from this big pump. So this, just singular candle, that's like, yes, let's go. That's it, right? That was their intention. They didn't even reach the supply on the daily chart. So to me, despite the move being so large, it is not a quality demand zone. We still don't know what these tariffs are going to do to the economy, right? So we have to, take it with a pinch of salt, especially areas that were created through headline risk. Those generally don't last, especially if there's new information that is conflicting with whatever was said initially. This was the delay of tariffs. Since then, we've had adjustment of tariffs, and the market is just not responding very well. But at the same time, the super crazy volatility has been a little bit absent. So we've been wagging up and down, but in a much smaller range that would be a little bit more normal. Dow is still very quiet this morning. So 4-hour charts, we haven't really moved away from VWAP at all. There's a clear downtrend on some of these time frames. But would I want to just keep selling this? Well, probably not. I want a really good setup to appear and then to see what we want to do with it. Now, technically this is failing the auction, technically. But, whether we're going to have any... look at the volume. This is a 30-minute chart. If we compare volume from last week during London, this was crazy, so let's not take that into consideration. Let's find London. Okay, so this was London. If you notice, this is 9 a.m. So this is what it looks like when Dow is moving. You know, you have slow start and then volume picks up because, you know, other time frame participants step in or somebody gets liquidated and then that brings in more bounce and more volume. We have none of that today. All the candles are like tiny candles. Tiny candles. Joe says copper and weekly over long time frame can we call the range, and now it's moving from the lower edge to the upper edge. Yeah, let's go back to copper and have a look. Actually, let's go to the full copper because that might be a little more accurate. So weekly time frame. I don't know whether this is a range. I would call this more an expanding formation, because if you want to have a range, the lows really need to stay. To me, this is all just craziness over headline risk, but if we're going to define it through technicals, let's change the color of this because I cannot see that color. Let's go yellow. And then if this was a former bottom, I mean, that kept getting broken. So now we have a potential for an expansion. It's not a big expansion, but the way I'm seeing this is a larger swing over on this side. And maybe a downtrend. I mean, the move that happened up at the top here, this was a liquidation move. And I remember it because I was like trying to do like my journaling and stuff, and I still had it in the corner of my eye. And then it just popped, and I was like, and it was out of hours. It was somebody getting liquidated, right? Literally as we opened Globex, it happened. So yeah, not sure how much stock I would put into the smash of the high here, because you can have the liquidation moves that cause a little bit of a trouble to the structure, but then it still remains the same. So to me, this would be a single print fade effectively if I look at this big large candle. And you know, on the weekly chart, we're in the middle of nowhere, so that's not very useful. Apart from noticing that there was a very, very big smash down that is now being invalidated. So if anything, I will be looking for more longs until we reach these areas here. But there is a bit of an expansion, right? It's not a true megaphone or anything. It's just non-committal reversals after smashing. So basically stop runs and then reverse. Stop run and reverse. Stop run and reverse. Whether that happens again when we get up here remains to be seen. Is that something that copper normally does? I don't think so, actually. Because last time I was looking at topping formations, they kind of looked normal to me. This was more of a distribution curve, even though it's a weekly range, but you know, you have to look at the shape of it. If there's a rise before and then you get stuck in a range, that's very different than having a range that's like this, that spans, you know, thousands of ticks. This one is more of a distribution curve. So I delineate between the range and a distribution curve. One represents possible distribution or accumulation and can bring some bigger moves upon the breakage of it. So look at this. So we broke the distribution area and then we went into a very nice liquidation. But if we look at this as a larger range, the moves are not as smooth and as predictable. Let's put it that way. This is all Wyckoff stuff, just basic market structures. And uptrends and downtrends can both have liquidations and markups. So I don't know how many people know about that, but basically I call them phase 1, 2, 3, and 4. And regardless of whether we're in uptrend, downtrend, you can still have markups and liquidations. if you know where to look. But yeah, I would be calling this a single print fade. So we left some single prints and now we're slowly going through it. I think this was just a marker from last week. So yeah, it's an interesting chart for sure. But yeah, I would be leaning towards longs unless like something else comes in. Right, let's have a look at some more questions. T3 says, what up, D? Top of the morning. Top of the morning to you. Mohammed has joined us as well. Good morning, Mo. Very good to see you all here. So let's see if we're going to have a zombie rally on copper. Let's mark the initial balance. Where is it? There it is. I'm going to change the colors of this because I want my initial balance to be red. So yeah, some expansion of the initial balance. Let's see if the volume is following that. Volume is still below its own moving average. So the little blue line that we have here. Whenever I'm looking for sustained auctions, I want them to be accompanied by volume. Because if they're not, like I don't use volume. Here's a misconception about me. I've said before, people are like, do you use volume? And I said, I don't use volume much. But people only hear the, I don't use volume. And then there were like quite a few people who were convinced I never, it's like, no, I said much. It's an entirely different statement to, I don't use volume. Versus I don't use volume much. Devil is in the detail, you know. So whenever, same thing when I'm talking about like stops and volatilities in my program, I said, you know, a certain formula for maximum default stop loss size. And they go, so that is a default size. And I'm like, maximum default stop. And I always have to pull people up on that. I'm like, listen to the detail, okay? There's a reason why I chose to say maximum default. It means you can never go over that number unless you're going to mess up your risk reward and statistical viability of your targets versus maximum versus just, you know, default stop loss. So it doesn't mean that I will always use that. You can go smaller. You can just never go over that number without getting negative results. Yeah, but people only hear what they want to hear, and you know they kind of. I always feel that a lot of people who are listening, they sort of listen partially, and then they extrapolate things from it, and they're like, why isn't this like? Or you know, I get questions like, you want me to use a 250 tick stop, and I'm like, what? No. Why? They're like, maximum. So no, the default stop. And I'm like, maximum default. If the structure obviously allows you to minimize or to somewhat minimize the stop without you being exposed to stop runs, or as we like to call them these days, liquidity grabs or whatever, it's all the same thing, right? You have a defined high. Highs and lows intraday, especially during the session, they typically love doing, like this is market makers games, right? They love taking stops of the retail traders who are always putting their stops super close to the recent highs and lows. That is their game. That is the name of the game, right? So if you're not doing that, and if you're, constantly placing your stops, like for example, let's say you wanted to go short on copper because you identified that this was maybe a liquidity grab, and you place your short. So you're like, oh, the liquidity grab is over. So now I'm going to skimp on stops and I'm going to make it look like this. It's like, great, you have a positive risk reward. But the new session high is also, like if you get it wrong, you won't give yourself enough time. Sorry, with these bright lights, I can't see anything. So let me just make this a little bit more opaque so that we can see what's going on. Okay, that's a bit better. So yeah, when you expose your position, to effectively be so close to the stop is so close to the previous high. That's a weak position. And there's a lot of wiggling in range-bound days as well. So if you get stuck in a range-bound day and your stops are nowhere in a near strong enough position to survive the new stop run, you're going to be in trouble. And then if you're wrong, it's not going to give you time for you to make a decision to pull the trade off because now it's invalidated. And that's just going to poke into your mental triggers. I see Jerome has joined us as well. Good morning, Jerome. So you want to avoid, like for me, being able to make my own decision to close a trade versus the market making that decision for me has a completely different mental outcome. If I get stopped out by whatever the market is doing, I don't like that. And that's just me. It's not, it's not everyone. But it is me, and I do everything in my power to keep my mental triggers at bay. So a couple of my mental triggers is if the market is not moving, I start going long, then I start going short, then long again. That's a mental trigger. So as soon as I notice myself doing that in a tight range, nowadays, even after the second attempt of flipping and not having the follow through, I would be like, whoa, hands off. So I stop myself before I can totally derail the P&L, right? So it's not about not being wrong. It's about being wrong and having full control over it, if that makes sense. So yeah, you have to make sure that your stops are always in a strong enough position. So for me, since we have 78 evens really close, the only way that, let's say, shorts, if I do have a short setup right now, I don't, but if I was looking for shorts, my idea would be to put my entry as close to the stop, to the round number, and then my stop some 35, 40, 50 ticks above that. Okay? If I don't do that, I'm literally in a weak position. Okay? If I'm outright wrong, I can usually see that because the trade starts spending a lot of time in drawdown. There's no real reaction. So it basically almost never goes in my favor. Maybe it goes by like 5 ticks or something. But unless I'm looking at a much larger time frame and I'm expecting it to kind of last for 3 hours, if I'm doing an intraday trade that's going to last me 30 to 45 minutes, I want the trade to already start showing validity by going into profit within the first 5 minutes. If that doesn't happen, I'm like, there's either no volume or I'm totally wrong. There's no real third option there, or I'm mistiming it. So maybe it's not the time yet because there's no volume. So then you sit and you wait. I know, boring, right? But yeah, be careful about your stop loss placements. They can make or break your entire position. And similarly, they can also be a defining tool of whether you can hold your trade longer or not. Because if, like, let's say now we have low volume, everything is just meh. And I see people who want to do a trade. So it's like, oh, I'm doing a momentum trade. Now, some of the more experienced traders like Mo and Jerome as well, we look for almost an immediate push in that same direction. But at the same time, we use the signals. I do the initial balance breakouts sometimes. Technically, that is a momentum trade. But if that setup is not happening in an area where I would expect more initiation, I would be very careful how I'm actually executing that and what happens after I enter. If it goes into almost an immediate drawdown by minus 0.5 R, to me that would be an invalidation. Because that's like, you don't want it going against you immediately. Now, in the high volatility, that's a little bit tricky, right? Because everything is flying around. So the trades that you take will probably suffer some drawdown. And that's where something like maximum adverse excursion can happen. What I'm seeing on copper here now is that typical low volume zombie crawl upside, slow and painful. It's like we pop a stop, then we go down. We pop a stop, then we go. But let's see if we can catch something in this combine. Preferably not an STD. Don't want to catch those. They're bad. But let's try doing a little micro copper here. Jokes are starting, guys. I am awake. So let's catch some profits, not diseases, right? Let's see what that looks like. This is just a little idea that we're going to be having a zombie rally. I'm not doing this in my accounts that matter. But because we're streaming, you know, we want to illustrate some of these concepts as well. Now, it's entirely possible that due to the lack of volume, and me using a 35 tick stop here, which is fairly low for this environment, that we get like one big flush and then it just goes smack across my face. But that's okay. It's only a 3 micro. So let's not worry about it. But yeah, if I suspect that this is a zombie rally and we're just going to keep crawling, that is the setup. You know, it's not really a breakout setup. I mean, I suppose it is, but it's crawling breakout. Crawling breakout setup. That's the playbook. And it's literally based on nothing more than low volume. It's not really a random walk theory. It's more like some algorithms and, you know, people who are clicking buttons on 1 and 2 lots, pushing it through the liquidity vacuum, which is how I like to define single prints. So we know, remember, on the weekly chart, this is what I'm looking at. So I'm basically assuming we go through the low volume area. And it is a holiday day, you know, across Europe, UK, and the rest of the countries over on this side of the world. And we have seen the markets just kind of trickling in a single direction, not really doing all that much. So I don't want to short in a low volume environment. That's usually a bad thing to do. Short Life Hacks says volatility has died down. It's all earnings driven now. We'll see. Up to the next headline from Trump, right? Like tariffs, and then we have volatility. So, you know, we want to be ready. We want to be on the defense. But yeah, it seems things are a little less crazy than they were 2 weeks ago. I'm going to be honest, I've loved the volatility. I've absolutely loved it. Justino says, Mark Douglas said, love that guy, like said he's no longer with us. But yeah, what great, very insightful books. Mark Douglas said people naturally don't want to define their risk because being wrong in a trade reminds them of every failure they've had in their life. Yeah, I do remember reading that. Once you become aware of that, you know, me and Jerome are doing these Neuro Wednesdays. Oops, I was gonna vape, so let's not vape. Still waking up. Let's do a coffee instead. So yeah, once you start being aware of some of your own self-limiting beliefs, it's really odd how, and I've done this for myself a long time ago, right? So I've had not too many, so probably less self-limiting beliefs than some people, because I was always a little bit crazy and shooting for like really impossible goals that seemed impossible at the time, but then they all kind of started coming true. So my life experience is probably a little bit different than most people's. But yeah, I did still have this hang up about the sense of inadequacy due to me having an older sister who was naturally better than me at everything because she was 10 years older. And then my dad doing some weird comment how, oh yeah, just don't count on making money from that. And then I was like 3 years old. That stuck with me. But once you become aware of it, once you label your fears, it is unbelievable how much you then start to focus on the positives in life. So for example, for me, I've had a number of achievements, right? A number of achievements in my life. So anytime I feel like I'm like, oh, because everybody has these thoughts, right? You come across like a really difficult period in trading, and suddenly you're like, am I even a good trader? And then you're just like, what? Like, well, what are you even saying? But the more you define your playbooks and the more you drill, right? The more you practice to recognize them, execute them, what it looks like when they're not going to work. What are some of the conditions that you can really define properly in a playbook? Because all of my playbooks, they're well defined. And, for example, for a sustained auction, usually I want to see it closer to the value area or after some sort of a reversal. But I also know that I've seen quiet holiday days that hang above VWAP. They have low volume, and yet they just keep trickling. So there's like two versions of the sustained auction. Now, these sort of sustained auctions, they're usually not that juicy because some of them will only go to like 1-to-1. So I'm also painfully aware of the limitations that this particular trade setup has, and that's where I'm actually perfectly happy taking like 40 to 50 ticks. So maybe we can leave it up at 480 as the next round number. So instead of putting my entry there for a new trade, I am using it as a target. So the poor trader who's like maybe using 480 as their stop, they're going to have not such a great experience, right? Now, it's all down to labeling your fears, becoming aware, and as Jerome taught us last week, to replace, not ignore or push them aside, shove it under the carpet, but to recognize your thought processes that are in the beginning mostly random, but here's the thing, you can control your thoughts and know that your thoughts, that's not you. Okay, thoughts are a product, especially if they're like not, if you're not controlling your thought process to be a deliberate guide towards a particular goal. A whole bunch of crap pops into our heads, right? A whole bunch, and it's always negative. It's always like, you're shit, you're a muppet, you're stupid, you're this, you're that. There are a number of different techniques how you can kind of tone that down. But I kind of have the opposite problem. I'm pretty confident, and I was generally always very confident in my abilities, which is another issue altogether. But I still had all of that confidence coming from experience, journaling, just sheer number of hours that I've spent staring at the charts and being super interested in it. That brought me success, right? So I actually got a little complacent during COVID where everything was just so easy. Like I could literally be only partially correct on my analysis and the momentum would take care of any sort of poor trading location. So I got a little complacent, right? And then I also got the brain fog from my illness. So that made me even more complacent because I was like, oh, it's a trade. Yes, failed auction, that'll do. But then, you run into a drawdown period and you're like, what's happening here? And the old patterns might start to appear. But what you need to do at that point, you're like, hold on. Did I actually see that set up correctly? Especially if it was a negative trade. I feel that we learned so much more from the trades that didn't work out. I don't get spooked in trades. I think that's pretty easy to see these days. And that's my biggest strength. The fact that I can, like, if I know that my analysis is spot on from a multiple time frame view and it's going in my direction, I don't have that fear that Tom Huger talks about, which most people have, where they get spooked in a position and then they cut trades early. I've always had the opposite problem of holding trades too long because I'm like, well, this is going to reach it. This is going to reach it. And the reason why is because I come from a swing trading background. I did that for the first 5 years from 2007 up to 2012. And then I went into intraday. So I've seen my larger time frame playbooks play out at like a 70% accuracy over a number of days, weeks. One time I held a trade for 2 months and I got like, I think it was like 3,000 ticks out of it. And this was back in the day when we didn't have, such a crazy, it was just like normal volatility, right? So, having seen and lived through those sort of setups, I know what's possible. Now, intraday, I know that most of my trades will reach about 70 ticks in a normal environment. In the bigger environment, but it's also contextual, right? So if I have a range-bound day and we only have like 70 ticks available from top to bottom, session high, session low, and it's a range, obviously squeezing out 70 ticks all in one go is going to be much more difficult. So in that regard, I will reduce my targets to like 50 ticks, 45, 50 ticks, while still using my normal 35 ticks. But I will tell you that during the volatility, I was using up to 65 ticks on copper. But the targets were bigger. I was getting 260 ticks for target, not 70. So, take that as you will. But, it's all scalable. To me, volatility is just like it's a scalable measure, and we have to go along with it. I've seen some people in the VWAP who have not adapted to it. And I had someone who was like, oh, I'm not going to trade this. And I was like, why? And they went, because this doesn't match my risk requirements of using 20 ticks to get 40 or something along those lines. And I'm like, okay, using 20 ticks on NQ in this environment is not the same thing as using NQ back in October last year. And I said to him, we've had this volatility now for a month, 2 months, 3 months. What if this is here to stay? What are you going to do then? Not trade? So for the next, 4 years, if we have tariffs bringing high volatility like we had during COVID, okay? So let me rewind and get to COVID. Before COVID, equities were not that volatile. They were like, kind of moving, but not really. And then COVID hit, everything went crazy. And that stayed. The increase in volatility didn't stay at the same level, but it kind of got increased permanently by about 40%. So since COVID, we've had expanded ranges on ES and NQ. That's why I brought ES back into my trading, okay? Because suddenly I was like, all right, it's not... Even NQ, like back in when I started looking at it, it was moving in like 75 points for the entire day. That was your NASDAQ trade. And when people ask me, why do you don't like NASDAQ? Because that was my experience with it. And I watched it do the same thing for years. For years. It wasn't like, oh yeah, it was quite a few months. No, it was like 7 bloody years of watching NASDAQ doing F-all. And I'm like, it was moving during earnings and then it would go bonkers. But, that's like, 4 times a year or something. So it's not really, volatility should be looked at as a tool, right? But your system and your strategy needs to breathe with it. Because, if volatility goes away, you can move to another thing. But if it's still sort of doing the same thing, like still doing the same playbooks, only on a smaller scale, that's still okay. I run into problems when the playbooks stop happening altogether, right? So they're like, break out of the initial balance, nothing. And then it hangs above the initial balance, neither failing the auction nor continuing in the same direction. So it's like, okay. So when that happens, I move away. I move from the product. And I usually give it about 6 months before I will do it, just to make sure that that is a new state that, we're working with. Until that happens, you're just like, okay, so what is the volatility doing? How can I, take advantage of it? And I will be honest, I prefer higher volatility than low volatility. I know people are like, oh my God, I'm totally screwed. But I expand my stop losses, I lower my position sizes, and then I just shoot for higher targets. And to me, that's very, very profitable. We gotta be honest, it makes things a little easier. I can still trade in normal volatility environments where, my trades tend to reach 70 ticks, but over like 2-3 hours. I'm okay with that as well. Okay, so we have to breathe and adjust and adapt. How did Mick from the risk team put it? Adapt or die. So yeah. All right, let's see. Short Life Hack says the tariffs have been baked in. As the inflation though and the consumer knock-on effect, I think we're going to be in for some interesting times, because there are some signs that, obviously the consumer confidence is going down. That's not that surprising, but I think the real problem will come when we see what the tariffs have done to the actual prices and the standard of living. But yeah, we'll see. OpenHead says 6 EM25 short. Thank you for giving us the full contract of the euro. You could have just said euro futures short. I don't trade Forex, and I know that it's gotten better. I prefer commodities, guys. I don't know. I really do prefer commodities. They have smoother moves. They have very defined movement. I kind of feel like currencies have gone the way of over speculation. And whenever that happens, when you have too many speculators, it brings very choppy price action. And after nearly 2 decades of doing this, I prefer to be very picky with the kind of price action that I want to trade. So if that's something that bothers you, fair enough. But you will find over time that the less effort that you can, and the less mental capital that you can spend watching something actively and living your life, enjoying the fruits of your labor, right? That's preferable to you trying to squeeze out 30 ticks in very choppy price action. So whenever I see price action that has a lot of overlapping candles on a 30-minute chart, I effing hate that. So let's have a look at 6E. Yeah, so to me this is choppy price action, right? Inside bar, inside bar, inside bar. Oh, we break out. Inside bar, inside bar. Oh, we break out. Inside. I have noticed that our Asia friends have been very smooth. So, if you can trade the Asia markets, I would say that's probably the smoothest price action across the board that you can find. I'm not awake during that time. I only do Asia trades when we've had a huge outlier move, and then I like to fade that. But that's the only time that I will sacrifice sleep for potential setup. Other than that, But yeah, I do think that euro has a very similar outlook to what copper is doing, so that like zombie rally. But I wouldn't short it. In a low-ish environment, you don't want to be shorting it. So if you're shorting it, good luck. If it doesn't work out, yeah. This is looking like a zombie rally to me. I'm sorry. We've also gone above the previous high. This is the daily chart. This is the weekly chart. I mean, isn't this like a breakout? I know we've got a little bit of supply here, but it's more of a middle of nowhere supply. Why are you shorting here? Like, if you can give me a good reason, I can, have a look. But if you're shorting it just because it went up, that ain't a good reason. Like, I'm sorry to break it to you. Short Life Hacks says, I remember. So, by the way, Short Life Hacks is from the institutional background. They've got a lot of experience, and they can tell you how it used to be. He says, I remember ES, we were grateful to get 2 points and traded 100 contracts for that 2-point move. Very different, right? Imagine being happy. But that was like full S&Ps. That's like 250 a pop, right? 250 a point. and then you trade, 100 contracts. That's nice money. But yeah, 2 points. Now, when I started trading it in 2013, it was 4 points. So it's like, whoa, we doubled the range. And compared to now, when we have, let's see how many ticks / points we have. Whoa. Yeah, I can already see that number is pretty sizable. Oh my God. I mean, what is this market even? What are the days we live in? So that's 695 divided by 4, because those are in ticks. 173 ticks, 174 ticks per day. So we have short life hacks saying 2 points back in the day. Then 2013, 4 points. Then we had COVID, everything went nuts. Then we kind of settled in this range of around about, I think we had maybe 70 points for a long time, like roughly about 200 ticks, 180, 200. And now we're working with 174 points as an average. You can't trade the same way, okay, that you did when we had peanuts versus incredible amount of tickage available per day. So think about your strategies in a strategic way, in like a more critical thinking and more mathematical as well. Ultimately, this is all, strategies based on some data science probabilities. Like it's not, it's not that scary. Right, let's go back to my copper. It's doing okay. 30 ticks. Wait. Oh my God, am I going to get my target during the stream? Whatever next. Maybe we should have a holiday day every day. I'm now considering working on the 5th of May. We're going to see if we can find somebody to replace me. I do feel like with this move, and we haven't moved yet, we're aiming towards, like, we're going to know the completion date on the house this week, and then anywhere 29th, 30th, 1st or the 2nd. I know that they can't do Tuesdays, and to be honest, I can't do Tuesday either. But yeah, it might be that I'm moving next week. It might be. Now, I do worry about the internet, because obviously I'm going to be doing the London session, then we're going to dismantle my computer, then I'm going to move on that day. And I kind of feel like once I move, I need a few days to kind of settle in. I am probably going to be doing streams from like some office in Guildford for the first few days, because I don't know whether I'll be able to get Starlink immediately, because I have to get Starlink. I'm going to the countryside, guys, so I'll be in the middle of nowhere, and hopefully they can get it to us within like a couple of days, and if not, and I'm trying to make that happen over the weekend. So I'm asking for a lot, but we'll make it work. We'll make it work, definitely. So yeah, we'll see how it happens. What are the 3 lines on the chart? This is just a little moving average. Robocop, love the name, by the way. Big fan of Robocop and pretty much anything science fiction related. huge fan of science fiction. Yeah, so it's just a 9 EMAs plotted to the high, the close, and the low, so that they never cross over, okay? I use them as timing tools. I know that Mohammed, he uses them in a similar way, but I think you use them as levels, Mo. I'm not entirely sure, but from what I've seen, you do use them as like points. I only use them as a timing tool, and I use them on super low time frames. So for example, I might be using them on a 2-minute chart to see, okay, I am going to move this to break even, primarily because of the low volume. And if this kind of goes back to smack me on the face, I don't want to lose anything today. Because like I said, it's kind of like a bank holiday day. I don't want to stress myself out. I rarely move it. If I'm going to keep this for 3 hours, I would have just kept the stop where it was. But obviously, we want to make sure we're not down on the stream if we don't need to be, especially in a low volume environment. So yeah. But yeah, I use them more as timing tools. So for example, if I'm looking to enter a trade, I would be looking for the market to make a decisive, bigger candle move and for it to go either over or under the ribbon on a low time frame. So that's the only way I use them, but obviously I look at order flow. I have Bookmap on the other screen. I obviously have time and sales here, but Bookmap is my preferred way of looking at things and order flow. And you know, this is just like the final step to make sure I'm not getting involved when the ribbon is flat. If I'm looking for momentum trade, and if I'm not looking for momentum trade, to make sure that we don't have some crazy action going in. Okay, so now I'm going to close this. Why? Because the market is actually dipping below this ribbon. And I said it's a low volume environment, and it's basically dangerous to keep holding this. It already tried to go higher. It might keep going higher, but that may happen like over the next 3 hours, right? And I just don't want to do that. So I'm going to take my little $50 here and be happy with that. It was just a little zombie rally trade. Now, copper is a commodity, right? So you're not going to see zombie rallies that behave the same way as in equities, where they just go and they're like, how did I miss that? And then you go, it's so far away that you can't even see it. And then we're all wondering, how do you limit risk here? How? Stop Hunter says, good morning, Dee. Do you add to winning trades? I don't. I will add to my losing trades. I know. Oh my God. Really? Now, I use a zone, right? So whenever I'm looking at something, you've noticed that my stop losses are not big. So they're not small. They're sizable, right? Still within the statistical viability of the volatility that we're working with. So let's say if we have 200 ticks, you know, using a 30 to 50 tick stop is something that's pretty normal for me. Now, I have very good understanding of how my trades look. And usually, if I decide to just pop a trade in to try it, there is a 70% guarantee that those types of entries will suffer a drawdown, but no deeper than 22 ticks if the trades ends up working out. I also have probabilities attached to each of my playbooks that I'm taking. So I know that, let's say, doing something like this, which was a sustained auction attempt in a low volume zombie rally sort of situation, when we are away from relevant areas like the distribution curve, aka the value area from Friday, those have a lower probability of reaching the full target, right? But at the same time, if it hadn't moved away in my favor immediately, I would have just cut it like immediately. But it did. So I got a few ticks out of it. It's fine. Now, if I'm doing a mean reversion trade and we're sitting around, let's say, a call resistance of some sort, but we've also come up quite a bit from, let's say, VWAP. We're far away from VWAP, but we're nearing the value area. And now I want to do a mean reversion back to VWAP, for example. I know that sometimes I want to be in on that just in case it goes very quickly, which is the nature of mean reversions. But I also know that I might suffer a drawdown. So what I will do, I will use the area in between the MAE and my entry, the first entry, to average into the trade. And sometimes if I'm really looking at a very high probability setup that has like 77% of probability of happening, I will even do like 3 add-ins, not just 2, but 3. So I will basically go in once, then go in around sort of 15 to 16 ticks, and I will go in again at about 22 to 25 ticks, and then hope for the best. Now, what that does is it improves my average. So one thing that I have a huge problem with is people adding when the market is already markedly moved away from them, and then they add 100%. I hate that. Like, whenever I see that, I'm like, what are we doing here? You've just completely like unless you're doing some crazy momentum trades, that's acceptable. But I see people doing this during range bound days. So you had a perfectly good entry, right? Now on range bound days, I would never do that. I wouldn't scale in. It's just one and done. So I go in with full size, decide what happens with the trade by the way the price action behaves after I've entered. And it's like all in, all out, no scaling it, because there's no time, right? Range bound trades take a while to set up. Once they've set up, you have, a limited amount of time to actually profit from them. And they're usually less, they're 1 hour. But when I have time to kind of, mess around, it's all slow, we're kind of still consolidating around an area in an expectation of a mean reversion, that's when I will be scaling into a trade that is in drawdown. But there's like I said, there's data attached to it. But what I see people doing is to go in one, and then the market moves like 50 points away from them, and they add another one. And then they're seeing a screwed up average entry, which is now nowhere near the original point. That is the bit that bothers the heck out of me. I can't trade like that. If my entry is at a place that makes no sense, that's a different trade. It's a different trade. So if I was going to add, it's not that I never add, but if I was going to add, I would be in with core three lots, and then I might add one once we're heavily in profit. But that one add, it's just a quarter of a position. So it's not going to massively screw up your average. I can add like that, right? Now, on most of the prop accounts, they are not large enough to be doing that. On some of my other accounts, obviously, that could become a possibility. But again, it's a very specific time and a very specific add-on. If you're adding 100% to your position, I don't know what the objective of that is. That's like, to me, that's like clear emotional trading. So I would always start with a core position that has a little bit of room to add up to the maximum default size. So let's say that your default size is 5. You start with 3, and then it sort of moves a little bit. You maybe add 1, but then you wait for that final add until you're really in profit and you just want to eke out a little bit more out of it. But doing this whole thing of, and I know that all of you are quoting Tom Hugard, but have a look at his interview from last year where he said that adding into the position has blown up in his face massively last year. So be very careful with that, because if you don't get the move that you're after, all you're doing is massively increasing risk. And most of you, unlike Tom, are not very objective with your trades, because he cuts trades when they're not doing what they want, what he wants them to do. He's just, oh, F this, click, he's out. Most of the traders that I see, what do you guys do? You enter a million lots, you're like, oh God, and then you're like, oh no, it's not going well. And then you sit on it. You can't sit on it. Take the money profit. So, there's a huge difference from what Tom is doing to what somebody who's been trading for 6 months is doing, and attempting to emulate a person who's got, oodles of experience and has worked for City Index as well. So be very careful with that. If you're not objective, and if you can't figure out when it's a good time to cut your trade, if you're still high on hope, it's going to go, and then you watch this massive position go against you with a really crappy average now, and then the average gets reached, and you're like, it's going to turn around, what do you think the outcome of that trade is going to be? Not positive. So, be very careful how you're going to approach that. So, yes, there is a use for it. I'm not in favor of it. I certainly wouldn't teach people how to do that in the first year of them trying to, better themselves. Because it's the sure way to make you messy as a trader, okay? If you've been trading for 20 years, do whatever you like, okay? Again, this is not for you. This is not for people who have been trading for 7 years, 10 years, even 5 years. I would classify that as an advanced trader already. Maybe not as advanced as somebody who's been trading for, 15 years, but you are better than, more experienced than the dude who just started, Dave, your mate Dave down the road who just started 3 months ago. Clearly, it's going to be a different set of skills, right? So yeah, be careful how you add. And notice that most traders who do add to the position on Topstep, they have a core position that is bigger than the add-on, right? They don't necessarily go in, oh, I'm going in with 5, now I'm going to add 5, and then I'm going to add another 5. It's like, you can do that if that's your maximum default size, starting small, like let's say 5 micros, then add 10 micros, then add 15. That's okay if you're working with a strategy. But if you're just willy-nilly adding because it's going your way, I promise you that's not going to end well. Okay. So yeah, I personally do not like adding unless it's a small add-on onto the original position. So, 3 full lots, add 1. That's okay. I've done that. 1 lot, add 1 and add 1. Terrible. I can't do it. Like, it's literally out of my DNA to do that. Because I'm just seeing it as 100%, 200%, 300% trade that has nothing to do with my original trade idea. So therefore, what the F do I do with it now, Yeah, Tostino says, Tom often puts stops at break-even in his scalps. Not sure why yet. Got to write this down so I don't forget because I'm guilty of it. D said, take profit. Yeah, exactly. Just take profit. Right, let's have a look. Trading Nickel says, yes, you're right. When people scale in badly, I'll fade their activity. Like your style. Yeah. Did that yesterday on silver and won. Excellent. Yeah. Justina says, Tom H live streams, live trades near daily. Don't know how he does it. Yeah. He's spoken about struggling with the mental side of things when he has a losing day. And I'll be honest, I've experienced that as well. I'm somebody who has ballpark average accuracy, like 43 to 53%. There are times when I am smashing it at like 80%, but that's not the norm. Like for me to say, yeah, I have 80% accuracy and 2.7 profit factor, that's not the reality, right? My long term, all good days, all bad days, without resets, without nothing, it literally settles at 43%, and between 1.7 and 2.3 are profit factor. Okay, most of the time I will sit around 47 to 50%. Very average, right? Very achievable. So to me, anyways. But yeah, when he was still very open to talking to people and to being very approachable, very accessible to everybody, he did get really bad, like online bullying and abuse. I've been through that as well. I don't talk about it very often because, frankly, I don't give a shit what some random troll will write. But I've gotten some fairly nasty DMs. Okay, really, really nasty DMs, and I've told the team about it. They knew about it. They basically just said, yeah, if they still bother you, just let us know. But basically, it's so interesting that when you have a day that is a control loss, people start going, oh, what, you can't trade and blah, blah, blah. And then it goes into like this hyper sort of sexual online abuse, right? And you're like, what are you on? Like, just take your meds, man. It's like, leave me alone. The way I deal with it, I block, report, mute, whatever. But usually block, so they will never see the post. They can come and, talk shit over here, but then Bruno will take care of them. So, there is no point bashing people when they're having a bad day, and yet there's a lot of that. And bad day, very, very scalable, right? So you have control losses, which should be okay. You shouldn't bash people for having a control loss day. And yet that's what we get in the industry. It's like, nobody wins 100%. If they tell you they win 100%, run away, okay? Because that's not true. There's something going on there. But, we need to somehow, I don't know how that's even possible, but we need to somehow work towards less toxicity in this game. I've even had people who are bashing me whenever I've had good days. So, I'm smashing it, and they're like, oh yeah, well maybe you can trade, but you look like a whatever. And I'm like, so now you're going to the physical appearance side to bash me because you couldn't find anything wrong with the trade that I've done. It's like you can't bloody win, can you? So after a while, I've been online, like in the social media space for about 10 years. I really couldn't care less, guys. It's like, what you think of my face, it's my effing face. I can't change it. What you think of my trading does not affect my life in any sort of way. What you're going to send in the DM is just a reflection of your own life, not mine. I always feel a little bit sorry for those people because they obviously have issues. But at the same time, they're kind of trying to derail something that they think is going to be very relevant for me. And it isn't. Like, I'm sorry to burst your bubble. But I don't know trolls. They don't know me. They think they do because we're pretty, front-facing and stuff. And they feel like they have a right to encroach on your piece, not realizing that most of us, at this point, have such thick skin that, I would I would need a lot of sort of cocoa butter to break through that barrier that we've all built up. So yeah. Tom Hugard, Linda, he wrote the book Best Loser Wins. I see your question here. Yeah. He's a very popular author and a trader who does live stream. So he's put forth some very publicly how he's managed to sort out some of his issues. Lol, wait, where do these fools DM? So far I've had Instagram and Twitter. Twitter being the worst offender. Instagram for some reason seems to be okay. Every so often you get some moron, but generally it's Twitter. FinTwit is like, I need to get my little animal. The animal from the Muppet Show? I have a puppet of it somewhere in storage right now, but I'll get it out. So anytime we have an angry troll, I'm going to bring it out and go, rah! Yeah, micro, yikes, micro Nikkei. Don't trade that, dude. If you have a personal brokerage, like I don't know whether we're talking prop firms or not. I'm trying to see where we are. But yeah, there's a Osaka contract for Nikkei. That's where most of the volume comes in. I almost kind of feel that the full Nikkei is a derivative of that. And that's why we see kind of small volume. But then when it moves, it seems to like really move irrespective of what the CME does. So yeah, if you can... so big spreads in M and K will do that. Minus 2K and unrealized, yeah. So be careful of illiquid markets. This is why we say that live trading and sim trading, not the same thing, right? And some people will blame the broker for that. It's like, it's not the broker. You're trading an illiquid market. Let me give you an example. When back in the day, we had Topstep rolling some of my unusual commodities. I requested RBOB, and they rolled it early. So not looking at the actual contract letter, I went to put in the trade, and I didn't realize they haven't rolled. Just never even occurred to me to look. So I pump in a trade. Within a nanosecond, I was down minus 1.8K. And I was like, what? And then it didn't close me out, but it started wagging up and down. Minus 1K, plus 3.6, minus 1K, plus 4.8, minus 2K. And I was like, this is the spread. Oh no, I'm the only one trading this. Oh no. So I promptly shut it down. Luckily, I ended up, I think, break even or something. I managed to catch it when it was wagging. But yeah, that hurt. That hurt. Because it was like, Jesus, man, that's scary. What's going on here? Breb Dad says, you're an awesome person, Deeyana. Thank you. So are you. I have to finally sleep, so I'll catch you later. Yes, excellent. Have a good sleep. Thank you for being here. 2010 flash crash, short life hack says, ES at a 10-point spread, 70 even bid, 80 even offer. Ouch. After the spike down, I was a rookie back then, 2 years in on KCG. Yeah. Scary stuff. Yeah. The tactical trader says, I'm always off with trading and after a weekend need some time to adjust. I think everybody does. I think everybody needs to adjust. Let me see if I've missed some questions. D, explain me volume profile. It's a profile of volume. Just joking. So it's like a vertical histogram is how I would classify it. And it does have a couple of useful additional measures. So first up being the point of control. That represents the thickest point of the profile. It doesn't control anything. It just means that that's where most volume happened. Usually after overnight trading that hasn't really moved much, you will see a lot of volume printed there. Why? Because there's time. You know, volume and time are not two separate elements. They are a part of the same equation. So when you see the thick volume POC that hasn't moved anywhere, it is maybe good as a target, but not so good as Bruno was highly amused by my joke, but not maybe that great as an entry, right? If, however, you have a momentum market and you start to see volume building and you're in a sustained auction, let's say a move that's going in one direction, whether up or down, doesn't matter, works the same way. And then you start to see a slowdown, and then you see the volume point of control drop in the opposite direction or doesn't move. So we've spent time. That can be a sign that the trend is over. If the volume point of control keeps moving up, it means that there's still some juice in it, but I would probably use low time frames for that to get like a better information on the strength of the move. And sometimes, like for example, to illustrate that right now, we are starting to build volume around 478.05 on a 2-minute chart. What does that mean? Well, I bailed out of this because that was one of the reasons why I wasn't very happy with it, because I saw the point of control was creeping up, but then not moving higher. And now price is trying to dip below it. That means we have the possibility of this not continuing higher. So the volume POC has moved up. This is just a visible volume profile. You can use it as a fixed range as well. But I like to switch through different time frames and then see their own volume profiles. And then the next concept is finding relevant supply and demand areas. How? By looking at where the gaps are and also looking at whether we have some swing extremes and what they look like. Now, this particular chart, not that great. Let's have a look at the 4 hours. All right, so I would say that this demand over here is probably more relevant as a potential reversal because we have a little hole here. If you see this little gap, that's a low volume area. And typically, when we reach there, especially if they're like this small and they're just above the demand area, what tends to happen is the price dips there and then turns around. So if you're near those areas, you need to take note and go, okay, that might be a good reversal point. Now, the bigger the low volume node area is, the more likelihood that after that first touch and reverse, once we get up there, it's going to start chewing through it. And that's exactly what we have on the weekly chart. So I don't know whether you were here in the beginning, but I'm just going to show you the weekly chart. We are actually coming across a lower volume area here with very thin volume, already starting at 486.35 and then getting thinner and thinner the higher up we go. So it is very possible that we have room all the way up to where this move came from, based on the idea of the single print getting chewed up, taken out, because there's nothing here. The volume is sparse, so the price typically moves quickly through it. It is a weekly chart, so moving quickly might be quite a different thing, but I do have a little bit of a bias towards the upside because of that, even intraday. Now, you have to match the intraday to whatever you're seeing. I prefer the TPO profile, and I actually have that on my charts, which I have on the other screen. These are my indicators. They are currently only on MetaTrader 5, but we're working on Intraday as well this year. However, it's all like made so that I have perfect overview of TPO profile, volume profile as well, if I make this bigger. So this is the 4-week volume profile. So I basically just combine all of that, and I effectively figure out what the situational thing is there, and then I make my decision, right? I usually have 4 hypos. I don't limit myself to 1 hypo. I never go into a day with a bias, so I'm not like, oh, I'm going to buy it. I just wait and see. And then if there's an idea of what I want to do from a larger time frame, I sit and wait until something becomes obvious. Now that seems a bit discretionary, but to me, if there is a setup, to me it's like an eyesore. It's like, take me, ravage me. Let's have a look at more questions. Can we call this a failed auction? On copper? No. Why would you call this a failed auction when we're above the initial balance? I'm sorry, Bruno is laughing at my jokes, so that's nice. So we're above the initial balance. There's no failure of the auction. If anything, this might be a little auction fade. But to me, just the slowness of this whole copper move, we're either just going to keep dripping upside, painfully slow, or we're going to be going into a very painful range. And, you know, today I just can't be bothered with that. So, yeah. Do you scale out of trades? Again, that will be very much a case-by-case basis. Sometimes if I'm trading one lot mini, all in, all out. No other option, right? If I happen to be in more than one, I may, and let's say I'm shooting in this larger volatility environment, I had many opportunities to basically run trades that would go to 5R multiples. Doesn't happen very often. But I would cut my trade at 2R. And then whatever the rest does, that'll be it. Typically, I would like to take half at that point. That way, statistically, you have not messed up the average. And you have a net risk-free trade without messing with the stops, without putting it at break even, without doing anything. So unless the trade is in quite some profit, I will not be partialing, because to me that's just asking for even more. But most times if it starts to wag around after I've taken profits and it's like 2R, but it's not sure, I will book the whole thing anyway. There were, I think, 2 or 3 occasions. I had a really good Thursday last week. Was it Thursday? Yeah. So I was up like, I don't know, 1.9K. It was a nice day. I did scale out, and then it just shot up. It shot up, and I was like, damn it, should have held all of it. I'm not really in favor of scaling out before 2R, because it doesn't really do anything for you apart from mess, or for me, mess with the way I see it. See, I don't see anything on a single trade basis. I see it as, what does this do for my P&L statistically and probabilistically? So let's say that you have a move that is, requiring, let's say, a 10-tick stop, and you're aiming for a 20-tick target. It gets to 10 ticks, you take half off. So now, in order to reach a 1-to-1, you actually need a bigger move to reach a statistical 1-to-1. Does that make sense? And yet, all of you, or 90% of you, have no trouble getting hit by -1R full. So if you're so keen on the partial stops, on the partial targets, why don't you use partial stop outs to protect your downside? Because I do. I will use partial stop outs. So if I'm not planning to enter a trade and scale into it, but I think I want to be in with more size, I will plop in a bigger size, and then I will put a partial stop sub my MAE number for that product. Have you ever thought about doing that? because the equation is still the same. You're protecting your downside, but, or you're not protecting your downside, but you're so keen to take those profits. We go back to the Tom Hugard saying that we're fearful in winning positions, which I am not. So I just look at it from a point of view, okay, well, to reach 2R multiples, which is my default target, how big of a move am I going to need if I take half off ahead of 2R? I'm going to need a bigger move. I'm going to need 3 to 1. So now I'm doing more work and looking for more out of the market. It just doesn't, to me, it makes zero sense to be taking partial profits, because all that I've seen it do for people is give you a negative risk reward, because you're not using partial stops. It's like, use partial stops and partial profits, then you might have something. Until then, cutting off your trade before it reaches, 2 to 1, to me, it's like completely pointless, and you're just making yourself work even more. I want to work less, not more. I'm a bit lazy that way after 20 years of doing this. All right. Thank you so much for being here with me. I'm going to end it here. This copper seems to be just a bit range bound now. Why do I say that? Well, if you look at where my entry was with this little marker, we're still in that area. So this is very, very slow. So happy that I took some profits there. It might continue. But at this point, I'm not really interested in it anymore. Took a little bit of cash here out of it. Probably won't be trading the accounts that matter today. So I'm going to go and enjoy the bank holiday Monday. And I will be here tomorrow. Just like for most of the Mag 7. Okay, I don't have Mag 7 anywhere because, again, not an equity trader. But, yes, let's finish this up. Thank you so much for being here with me. We had a little trade. I'm going to throw some links for you. Now, from today, I do believe we are starting the 150K VIP sessions. So this is for us reaching 150K subscribers. That is starting today. My first one, I believe, is going to be tomorrow. But Discord is where all of that will be happening. So if you're one of the people who won in that raffle, we will see you in there. And if you chose me, thank you so much. I will do my best to share my knowledge and experience in the best way possible. And if you want to come hang with us, come say hi, share your journey. This is the casting call form. Anyways, that's all I've got for you today. So I will see you again tomorrow. Enjoy the rest of the broadcast. This is me signing off, Mark Stalker D. This has been the Euro Trade on TopstepTV. Take care.